Hello, I'm David Buckland and welcome to this week's video. Over the balance of this decade, I'll be joining the baby boomers who will be over 65 years of age. And extended longevity means my peer group should, on average, live to around 85 years of age. Ensuring one doesn't go backwards financially for that approximate 20-year period of possible retirement is a conundrum. When retiring, the first thing most people contend with is the loss of regular remuneration. And how are we going to replace those earnings with relatively reliable investments? The second thing that we may want to consider is how do we assist our children or grandchildren, given the biggest asset in most people's lives, their home, currently sells at such a high multiple relative to average income. I offer a simple example of my first property, purchased in my mid-20s and paying around 3 times my pre-tax income. I had relatively little savings at the time and no debt. The same property today would cost someone of a similar age at least 14 times their pre-tax income. Apart from their possible HECS bill, they must save hard or get assistance just to get a deposit down. And even if they are lucky, they are so far behind my generation, it's just ridiculous. One asset class worth considering for those heading towards or through the retirement door is private credit. Generally, it has achieved equity-like returns, which have typically averaged an annual 9 to 10%, assuming reinvestment of dividends over the very long term, but without the considerable volatility of ups and down markets. Or a high-yield SME fund, for example, which is designed for wholesale investors, celebrates its 7th anniversary at the end of July 2024 and has delivered investors an annualised return of 9.6% per annum, assuming reinvestment of monthly income. Assuming investors bank the average monthly income of 0.77% since inception, the average annual return would have been 9.24%. And the volatility has been low, with monthly income in a range of 0.6% to 0.93%, and the unit price has returned to $1 after every one of the past 82 monthly payments. Montgomery helped introduce the Aura Core Income Fund in October 2022. Over the first 11 months of fiscal 24, the monthly income payment from that fund has averaged 0.624%, or 7.4% a year, assuming monthly income is banked, with a monthly range of 0.57% to 0.66%. This fund is positioned further up the collateral stack, meaning it has greater margin of safety. So here's my thesis for the cash component of your portfolio, based on the above data. I've assumed a 12-month deposit currently earns 5%. Let's say you have $2 million and you put it in a bank and earn your 5%. In 12 months, you get $100,000. Let's say investor B uses some private credit and 60% goes in term deposits, earning $60,000. 15% goes into the high yield fund, earning 9.24% a year, and 25% goes into the Aura Core Income Fund, earning 7.48% a year. In the example I've just given, the second investor gets $125,100, or 25% more than the first investor. Pleasingly, $65,100, or 52% of that monthly income is now paid monthly, $5,425 a month, whereas investor A receives the entire amount at the end of the 12 months. It's important to note that the Aura High Yield SME Fund and the Aura Core Income Fund do not have the same level of capital guarantee as an Australian bank issued term deposit, and then therefore is of higher risk for a higher return. That's all I have time for this week. Please continue to follow us on Facebook and X.